Hello and welcome everyone to another session of Kuvera Insights, where we talk to industry experts to figure out how we should be managing our wealth. Today we have a special guest from Axis. Ashwin Patni is the head of products and alternatives at Axis Asset Management Company. He has over 16 years of experience, with 11 of these being in banking and capital markets. Joined Axis in 2010 as a portfolio manager for their PMS service, and now heads products and alternatives. Ashwin has experience with ITFC asset management. He's worked across the street, has very strong credentials. His postgraduate degree is from Calcutta, and he did his Bachelor of Engineering in Metallurgy from National Institute of Technology, Karnataka. And he is a CFA holder from the US. Welcome, Ashwin.
Hi, really happy to be here.
Great, Ashwin. So today we're going to talk about value as a strategy, how it is done in India, what is the future promise, why is it considered out of favor, especially in the last decade. It has been considered as a strategy that didn't perform as well as maybe say a growth or a momentum strategy performed, right? So we'll try and touch a lot of these bases, but let's start with what is value. Like, simply, if you have to explain what is a value-based strategy, and how does it work, like, what are some of the common ways that people look at value stocks?
Yeah, so these are basically factors or attributes that any stock can have. The simplest corollary I can think of is when we look at, let's say, a batsman. There are different attributes. You can have a strike rate, you can have average, you can have different attributes to define what that person has. And likewise, if you look at a stock, there could be different attributes. You could talk about its growth characteristics, its balance sheet characteristics, its P&L, or you could talk about this thing, which is the value. Now, value essentially is typically, or the most classical definition is essentially linked to the valuation. And hence the word value. So essentially, what you're trying to do is identify stocks on the basis of their valuation.
So what kind of valuation metrics have been looked at historically? And what are the popular valuation metrics that people are looking at today?
So I think it's evolved. The crudest, simplest one that people tend to look at most often is the price to earnings, to a certain extent, maybe price to book. What typically happens is that when you talk about price to earnings, there are certain things that it may not be able to bring out because the way the earnings are achieved also needs to be kept in mind. For example, you could have certain sales, and that sales converting into earnings. The quality of that, in terms of the cash flow conversion, in terms of the use of leverage, in terms of the use of other practices, can influence what is an appropriate price to earnings or not. So over time, what we have seen is that other investment styles, and those who are not pure value but other investment styles, tend to use valuation in a very composite manner. You don't look at just one parameter, you look at two or three, and you typically look at that in conjunction with other variables around the business to get a complete picture.
Fair enough. And value also happens to be, one of the first factors that was institutionalized in some sense, right? I think 30 years ago, if you said you are an investor, people would just assume you are a value investor. There was no value investor. Everyone was a value investor, right? So can you tell us some history about value investing? How long has it been in play, and what kind of excess returns, right? Kind of alpha such strategies have generated in the past?
Yeah, so great. It's obviously, as many of these things are, a lot of these things take their cue from the US equity markets because of just the sheer history that they enjoy and the last, more than 100 years of experience that people have there. Essentially, value, as you rightly said, was a very easy way for people to compare stocks valuation. It didn't matter what sector it was, it didn't matter other variables. If you saw that there was a stock which was trading cheap, that could be seen as one way in which you could sort of invest with the hope that it will get that the cheapness, I don't know if that's the right word, but the low valuation was essentially an anomaly and it will get normalized. That was really the premise behind which a lot of these strategies work. And that normalization could happen in the near term. It could take time, but as long as you are buying a low valuation, there is an inherent assumption that that low valuation is temporary, which will get normalized, which really will work. Over the years, I would say more in the global context and the US context, it has seen some periods where it's done really well. In Indian markets, to be absolutely frank, I think our history of the last 20, 30 years, it's been a bit more of a mixed situation. You talked about the fact that, especially I think in the last 10 to 15 years, there have been challenges, and we can talk about why those challenges have existed. So to summarize, I think it started first because it was also relatively straightforward in terms of implementation. Over the years, in the long chain of sort of the US type of history, we have seen episodes where it's done reasonably well. But I think in the recent decades, it's been challenged, not just in India, but actually quite a few other markets as well.
Fair enough. Fair enough. So, within Axis, right? How do you guys look at value, right? I mean, what kind of processes, what kind of frameworks do you use when you have to identify a value basket? And how is that different from, what a typical value investor would be doing?
Yeah. So I think the biggest challenge why a typical value investor may have struggled, I think, in the last 10 to 20 years is, I mentioned a few times that you're focusing almost disproportionately on the valuation rather than on the fundamentals of the business. And I think that's really the clue. Because what happens is that increasingly in a place like India, where there is a huge dispersion or disparity between the better run businesses and the poorer businesses, a lot of businesses who are cheap actually deserve to be cheap because they are
the classic value traps, right?
Absolutely, the classic value traps. So essentially, the bane of value investing is value traps, and those create a lot of wealth destruction, a lot of needless volatility. And that's where I think for any process to work, and in fact, we at Axis are calling our process redefining value, because we are not approaching it as a pure classical value investor. What we are trying to do is identify what can work as a long-term theme. And for us, therefore, it's very important that a reasonable valuation is combined with a reasonable or a good strength, a financial strength, and potential for that business. And you do not disregard the growth potential of the business. So that's the third lever. So ultimately, for any stock investor, what we believe is that over the years, what delivers returns is the growth, because you're buying a stock. Essentially, it's a growth, a call on the growth potential of that company. So the way we are redefining value is you're buying reasonably valued stock which have reasonably strong, financial strength, and you're not really betting that there will be a sudden unlocking or a sudden repricing. What you're really betting is that these are companies that have a really good potential over 2-3 years, because the cycle may change, because the sector situation may change, because the company situation may change, which is causing the trajectory of these companies to change. And as a result, you will make a reasonable long-term return from these companies. So it's a
so when you're looking
different.
Fair enough. Two questions, because this is a very interesting, way to think about value. When you're looking at financial strength, is this more along the cash flow lines? That how good are their cash flows? Are they actually generating cash, or is it all accounting numbers? Is that one of the things that you're looking at? And also, when you talk about in India, and this is true for a lot of emerging markets, there are good operators and there are bad operators, right? So there is a good management team and a bad. So are you also looking at governance factors?
Absolutely, and you pretty much hit it on the head. These are the two aspects. So I'll come to the financial aspects first,
Sure.
where one is the cash flow conversion, which is absolutely what you said, but also equally leverage. Because what happens is that even though you may have a decent enterprise value, but if the lot of that value gets taken up by the debt of the company, there is not much value left for the equity shareholders. So
Sure.
therefore, the gearing is a very important thing to be aware of, apart from the cash flow conversion. Coming to the other part that you said, which is absolutely core and key to success in Indian markets, is governance. Because if the management is not aligned to minority shareholders, it doesn't matter which factor it is. It can be growth, value, quality. It can be anything. You'll not make money.
There'll
So
be value, but it'll never get realized, right?
absolutely. So I think those are hygiene factors. They have to be done, and absolutely something that we would be doing as well.
So, having said that, in your opinion, right, when your investment team looks at the value cycle in India, right, where do you think we are? So, we've started seeing some reversion happening, I would say, late last year.
Yes.
Late last year is when we kind of finally saw value asserting itself again. However, some of them were misstarts, but it looks like um, it may not be the most favored strategy today. I mean, even today when we talk to everyone's talking about growth and momentum, but it looks like it is something that's gearing up for its next run. How do you look at the value cycle?
Typically, I think it tends to because of, there are many value stocks which tend to get disproportionately affected by the cycle, and
Yep.
therefore typically there is a reasonably large element of cyclicality which comes in whenever you look at trends on value. And one of the reasons why we have seen some of these stocks do well in the last 12 18 months is because of this expectation that we are not just the expectation, but even what we are seeing on the ground, which is a very strong cyclical recovery that the economy is showing from the challenges that we had before that. So I think to a certain extent, a positive cycle is something that works for these type of companies. But again, with the caveat that it helps only the right type of companies. It doesn't lift all boats. There are certain boats that will not get lifted. But yes, the better boats, definitely the cycle is something that really makes a big difference.
And at a portfolio level, what kind of payback period are you guys looking at, right? I mean, when you're looking at your portfolio, and you're probably, of course, you will rebalance it as appropriate, but you're looking at opportunities that are going to manifest in the next 1 year, where there is a trigger in the next 1 year, or you're also looking at deep value opportunities which might take 3 to 5 years to manifest. How's the thinking in terms of what kind of payback period
Yeah.
is being preferred here?
So I think, and great question, because I think this is one nuance which we really want to bring out in terms of what we're trying to do, because uh, we think that the payback or the target holding period has to be reasonably long. I think near
Sure.
3 years or longer, and I'll explain why. Because I think markets are reasonably efficient. I don't think there are some hidden gems just lying on the road for anyone to just come and pick up, and then suddenly 3 months later, there is magically a repricing. Uh,
Right.
if the stock is available at a reasonable valuations, maybe they are going through certain business challenges, maybe they are going through some cyclical challenges. Even if they are good businesses, they are going through certain internal challenges which could be linked to their management team or whatever else. And obviously these things take time to play out, and as the cycle turns out, etc., and the company starts posting better results, numbers, growth over a period of time, these things typically take time to play out. So most of the time, you could get lucky, and some stocks may play out a little bit earlier, but most of the time these things will require patience, 2 3 years
Yeah.
or longer.
Which also leads to one other question that I always have when running the value strategies. Are you guys are you looking at taking outsized sector and industry bets in this, or you would rather keep the industry diversification fairly in line with the larger indices?
So we like running diversified portfolios in a sectoral
Right.
sense. What we try to do is balance that out by running more compact portfolio in a stock sense. So that's the sort of balance we try to achieve, because you can control risk, you can control tracking error if you run a sectorally diversified portfolio. But stock selection, you really want to go for the best ideas out there rather than spreading yourself too thin. So I would say that's the balance that we would try to achieve here as well.
Perfect. And in terms of an investor and a retail investor looking at some of these value funds, some of them which are about to be launched, some of them that are existing in the market, what part does a value fund play in an overall investor's portfolio? How does it fit in that investor's portfolio? Should they think of this as a core allocation? Do you think that this is more of a satellite allocation? What is your view on how an individual should think about value funds?
I think it's still something that tends to be a little bit, volatile. It tends to be something that people don't understand completely so well. Unlike, I think, the quality growth strategies where, because of the last 8-10 years, what we've seen in the market, I think people understand better. And I think in an Indian kind of a market, there will always have probably be a core long-term opportunity. So I would, the way I would position this is something that is, if people have already got a core portfolio already and they're looking at complementing that with some top-ups, with some other complementary strategies, and that's where things like value can really come in.
This is actually a very good point, and I'll just add one more thing to do. What the point that Ashwin made, right? And just to bring it home a bit more. So what happens is a growth or a quality strategy throws out names which are trending. So the companies that are growth companies or quality companies are companies who are they probably have good tailwinds. There's great news coming out from them. You're probably using their products, so you already have a good mental model. You probably know that company, so there is some affinity there. Value strategy will throw names which you probably have never heard before, and that's why it's not the easiest or the most accessible strategy in that sense, right? Like, I mean, a company that's doing fantastically well is growing gangbusters, that everyone knows about, that everyone uses the product, is highly unlikely to be part of a value basket. And I think what Ashwin said, that is, they tend to be more volatile. They also tend to be more obscure names, so that creates a bit of a challenge. This is super interesting. So in so is the belief that this is a good time to add value, or is the belief that you should always have certain allocation to value throughout your investment journey?
No, I think we are long-term players. So it's not about timing. It's not about where we are in the cycle today, because these things always keep sort of going through their own phases. The best approach is to look at this as a structural long-term opportunity and make allocations. But as you perfectly correctly said, I think see it as that opportunity which is complementing your core allocations. And with that, but with a long-term horizon, I think people can do it. Nothing particularly good or bad, I would say, about the current time. We've seen value do really badly for many years. We've seen the last year and a half, and it's done well. I think these are part and parcels of the cycle. So nothing good or bad, I would say. Just see it as a long-term allocation.
Makes perfect sense. I think that sums it up really, really well. Different strategies come in and go out of favor at different points in time, and it's very hard to time it. Value, all said and done, is one of the very few strategies that has like a 50+ year track record in the West. And even in India, you can go back 30 years and it would have done fairly well if you were a value investor throughout. Even though the last 5 to 10 years are challenging. So absolutely all the points well taken, Ashwin. Thanks so much for joining us. It's been wonderful talking to you.
Thank you so much.